Texas housing market is entering a moment no one ever thought possible. The state built on growth, opportunity, and endless expansion is now stumbling under the weight of its own overbuilding. Texas, the symbol of affordable American home ownership, is reporting record inventory, collapsing prices, and a migration slowdown that shocks the very developers who bet everything on perpetual demand. What's happening inside these markets isn't a minor correction. It's a signal, a sign that the Texas boom has turned into something far more dangerous. And the collapse beginning here may be the clearest warning of what comes next for America's housing market. Across Texas, the housing inventory surge is no longer a trend. It is a measurable crisis. The state that once operated on tight supply and explosive demand is now confronting an oversupply so severe it cannot be disguised behind price cuts, promotional financing, or developer incentives. Statewide data shows 156,000 active listings as of June 2025, the highest level in 14 years. Inventory has surged 27.2% year over year, pushing available supply to 5.7 months, nearly double the national average of 2.9 months. A market that once depended on scarcity and bidding wars is now forced to confront a reality where buyers simply have too many options and not enough income to participate. This explosion is not subtle. It is visible in listing counts, price reductions, absorption rates, and days on market across every major metropolitan area. Active listings in Houston hit 34,676, up from 27,976 a year ago. Dallas-Fort Worth recorded 30,921, up from 27,131. San Antonio climbed to 15,527 from 13,366. Austin increased to 11,429 from 9,869. Even the brief lifts from mortgage rate drops fade instantly because the oversupply crushing the market is structural, not seasonal. Across the state, inventory has risen 53% above normal levels. When supply exceeds demand by this margin, prices don't stabilize, they fall. And once that process begins, it accelerates as sellers panic, buyers delay, and the market enters a self-reinforcing downward spiral. What disappears from real estate reports is not demand for housing. It is the financial capacity to afford what's being built. This inventory surge is more than a real estate metric. It is a national indicator. When the state that led America in home building, issuing 15% of the country's new home permits in 2024, cannot absorb what it constructed, it signals that the growth assumptions underpinning Sunbelt expansion were wrong. And because Texas operates as a leading indicator for migration-driven housing markets, a sustained inventory glut creates pressure that will intensify across Florida, Arizona, North Carolina, and every other state that bet on perpetual in migration. The collapse beginning here is not contained to one state. It is the first measurable proof that the Sunbelt housing model is breaking, and once that foundation weakens, the rest of the system follows. What's unfolding across Texas is a price collapse so abrupt that it has rewritten the definition of housing affordability in the state. For years, Texas was insulated from coastal market crashes because its prices sat below national medians and its inventory moved quickly. That advantage is gone. Home prices have fallen in every major metro. Austin's median dropped to $499,000 from $525,231, a loss of $26,231 in 1 year. Dallas-Fort Worth declined to $439,999 from $450,000. Houston fell to $370,990 from $375,000. San Antonio dropped to $335,000 from $339,990. These are not minor fluctuations. They represent the largest coordinated price declines the state has experienced outside of the 2008 financial crisis. This shift wasn't gradual. It was explosive. Sellers are slashing prices to attract any buyer willing to close. In Austin, 53.4% of active listings have taken price cuts. Dallas-Fort Worth follows at 51.7%. San Antonio sits at 50.5%. Even Houston, long considered the most resilient Texas market, shows 39.7% of listings reducing prices. When more than half of available homes are being discounted, the market is not correcting. It is collapsing. The scale of these reductions tells the real story. In June, the Big Four metros saw median price cuts of $15,000 in Dallas, Houston, and San Antonio, and $24,000 in Austin. Sellers are not trimming a few thousand to speed a sale. They are accepting losses of 5% to 10% just to exit positions before prices fall further. Two-thirds of closed sales in Texas now involve price reductions of $5,000 or more, with average concessions rising to $13,000, up from $10,000 a year ago and $11,500 the month prior. This price shock has reshaped decision-making in potential buyer households. Every month of declining prices creates an expectation of further declines. When buyers see listings drop $15,000 to $24,000 in a single quarter, the rational response is to wait. Prices will be lower next month. Inventory will be higher. Negotiating power will be stronger. This psychology transforms a price correction into a price spiral because every delay in purchasing accelerates the next round of cuts. The result is a widening gap between what sellers need to avoid losses and what buyers are willing to pay. Developers who borrowed at 4% interest and built homes expecting 7% annual appreciation now face a market where prices are falling 2 to 4% annually. Construction costs didn't decrease. Labor didn't get cheaper. Land values didn't drop. But the homes built on those assumptions are now worth tens of thousands less than projected. When the math breaks, the market doesn't adjust. It collapses. What emerges from this new pricing reality is a signal of broader economic stress. When the most affordable major housing market in America cannot sustain prices, it reflects a strain far deeper than real estate fundamentals. It reveals a buyer base that has reached the limit of what it can finance, even at historically low Texas price points, and the consequences extend far beyond the for sale sign. The real crisis facing Texas housing is not price cuts alone. It is the disappearance of the buyer the entire boom was built around. Middle and lower income Americans, once drawn to Texas by affordability and opportunity, are now confronting a financial squeeze so severe that even discounted home prices remain out of reach. When households reach this point, a $335,000 home in San Antonio is as unattainable as a $499,000 home in Austin. The market isn't losing marginal buyers. It's losing the foundational demand that justified construction at this scale. Across the state, the core indicators of buyer capacity are deteriorating simultaneously. Mortgage rates remain elevated between 6.5 and 7.5%, more than double the pandemic-era lows that fueled the boom. At 7%, a $400,000 mortgage costs $2,661 per month in principal and interest alone. Add property taxes, which in Texas average 1.6 to 1.8% of home value annually, plus insurance that has spiked 20 to 30% in the last 2 years, and the true monthly cost exceeds $3,500. That requires an annual income of roughly $126,000 using standard lending ratios. Median household income in Texas is approximately $73,000. This affordability gap isn't theoretical. It shows up in absorption data. San Antonio experienced the steepest decline in weekly absorbed listings, falling 36.2% to 1,026 from 1,608 a year ago. Houston's absorption dropped 21.6% to 2,395 from 3,053. Austin fell to 780 from 814. Even Dallas-Fort Worth, which held relatively steady, saw absorption decline to 2,344 from 2,400. These numbers represent real buyers who either can't qualify for financing or choose not to purchase because the math doesn't work. But the most immediate blow comes from migration reversal. Texas built its housing boom on the assumption of endless in-migration. In 2022, net domestic migration brought 222,100 new residents to the state. By 2024, that number collapsed to 85,200, a 62% decline. The people who were supposed to fill these homes stopped coming, and many of the people already here are being priced out or leaving entirely. This population shift is reshaping the entire market. Developers who started projects in 2021 and 2022 when migration was peaking, delivered homes in 2024 and 2025 into a market where demand had evaporated. The pipeline couldn't be stopped. Permits issued in 2023 became completions in 2025. And now those completed homes sit empty, driving inventory to 14-year highs while prices fall month after month. What's happening is not a cyclical slowdown, but an erosion of the assumptions at the foundation of Texas growth. For decades, the state's housing market operated on a simple formula. People move here, demand rises, prices increase moderately, builders construct more, repeat. That cycle is broken. Migration slowed, demand weakened, prices fell, and builders, locked into projects started years ago, kept delivering supply into a market that no longer wants it. This disappearance of the everyday buyer marks a turning point. The household that sustained Texas real estate for decades is no longer able to participate, and that absence is reshaping the market far beyond the price reductions visible today. The collapse of affordability is not a marketing problem. It is an admission of mathematical failure inside the Texas housing model. For years, the state's competitive advantage was simple: build fast, price low, attract transplants. But the economics that made $250,000 starter homes possible in 2019 have been dismantled by a cost structure that rose faster than any price increase could sustain. In today's environment, a home that costs $350,000 to build and finance cannot find a buyer willing to pay $375,000, and no developer can survive under that equation. The inputs tell the story clearly. Construction costs surged 25 to 35% from 2020 to 2023. Lumber, concrete, steel, and copper all spiked. Labor shortages pushed wages higher. Permitting and impact fees increased. Land prices, especially near major metros, doubled or tripled. By the time a home reaches completion, the combined cost of materials, labor, land, financing, and fees often exceeds the price buyers can afford. Developers who locked in construction loans at 4 to 5% interest now face renewal at 8 to 10%, turning marginally profitable projects into guaranteed losses. This is why price cuts are ubiquitous. Builders are not strategically discounting to accelerate sales. They are panic selling to avoid holding inventory they cannot finance. When 53% of Austin listings take price cuts, it's not because sellers want to be competitive. It's because they're underwater and desperate to close before the next interest payment comes due. This breakdown in pricing structure is also reshaping developer strategy across the state. Builders cannot sustain deep discounts without erasing equity. Yet they cannot maintain asking prices without losing buyers entirely. The gap between construction cost and buyer willingness to pay grows wider each quarter, pushing developers into a no-win scenario. Some are walking away from projects mid-construction. Others are converting unsold inventory into rentals. Many are simply declaring bankruptcy. What emerges is a harsh reality. The era of affordable single-family home construction in Texas has ended. The foundational bargain that supported the boom, high volume at moderate prices, no longer balances. Builders cannot profitably deliver homes at prices buyers can afford, and buyers cannot stretch incomes enough to meet builder cost structures. Without that alignment, the entire market becomes unstable, setting the stage for far deeper contraction in 2026 and beyond. The collapse of the pricing model doesn't just reshape buyer behavior. It forces the harshest consequences onto the people who actually operate Texas development. When the economics of volume construction break down, the first to feel the impact are not institutional developers with diversified portfolios, but the thousands of small and mid-sized builders who build Texas neighborhoods lot by lot. Their financial survival depends on the very price structure that no longer works, creating a direct continuation of the pressure exposed in the previous section. For these operators, the numbers have turned unforgiving. Land purchased in 2021 at $80,000 per lot now sits in subdivisions where comparable lots sell for $50,000. Homes framed at 200,000 inches material and labor costs now appraise at $185,000. Financing that seemed manageable at 4.5% is crushing at 9%. Add property taxes on unsold inventory, insurance that has doubled, and carrying costs that accumulate monthly. And a project that projected 15% returns now generates 20% losses. At the same time, the weakening buyer base removes the one mechanism that previously kept developments profitable: rapid turnover. In 2021, a home listed Monday might close by Friday. In 2025, that same home sits for 60, 90, or 120 days, bleeding holding costs the entire time. For developers who finance projects expecting 6-month sellouts, a 12-month timeline becomes catastrophic. Interest accrues, taxes compound, insurance renews at higher rates, and every month of delay turns a viable project into a financial trap. Debt makes the situation even more brittle. Many builders borrowed heavily using land and partially completed homes as collateral. With values falling 10 to 20%, those loans are now under-collateralized. Banks are issuing margin calls. Builders either inject fresh equity, which most don't have, or face foreclosure. A development that generated consistent returns from 2015 to 2022 may now be worth less than the outstanding loan balance purely because market conditions shifted faster than projects could be completed and sold. Institutional pressure offers little relief. National builders want standardized floor plans, consistent margins, and predictable timelines. But local builders face ground-level realities that no corporate strategy can solve. A spec home that pencils in Dallas at $375,000 loses money in Austin at $400,000 because local costs are higher and buyer incomes are stretched thinner. Operators are caught between lender demands and market realities, unable to satisfy either side. This is where the system begins to fracture. When the people building Texas housing can no longer survive the numbers, the decline is no longer theoretical. It becomes structural, a warning that the development model is broken and everything depending on it is at risk. The strain crushing Texas developers is not isolated to one city or one builder type. It marks the entry into a broader construction recession now sweeping across the entire state. Once home prices fall and buyer demand weakens, every participant in the housing supply chain, from framers to finishers, from lenders to land sellers, begins to feel the same tightening vice. The financial collapse unfolding inside Austin developments is simply the clearest example of a statewide pattern. Across Texas, data from building permits shows a synchronized decline. Permits fell 1.2% in September 2025. Single-family home starts dropped 2.7%. Dallas saw permits decline 5.4%. Austin fell 3.4%. Houston dropped 1.2%. These are not mild adjustments. They represent a contraction in new construction activity that signals developers are pulling back, banks are tightening lending, and the pipeline that fed years of growth is now shutting down. The cause mirrors the pressures already described. Buyers have less financing capacity, prices continue falling, and construction costs offer no relief. But the impact becomes even more severe for smaller regional builders who lack the balance sheet strength of national firms. A downturn that a public home builder can absorb for 2 quarters can push a local operator into insolvency within months. When closings stop, cash flow disappears. And without cash flow, projects stall, subcontractors go unpaid, and lien notices start piling up. The third quarter of 2024 showed an 11% year-over-year growth in new residential construction permits, the first annual growth since 2021. But that growth was a lagging indicator, reflecting projects initiated in 2023 when optimism still existed. Those permits became completions in 2025, feeding the exact inventory glut now crushing prices. The construction surge of 2024 created the oversupply crisis of 2025. And now, as permits collapse, the market faces a new problem, a future supply shortage that will emerge once this inventory is finally absorbed, likely in 2027 or 2028, setting up the next cycle of volatility. As each builder weakens, a new pattern emerges. Project suspensions, workforce reductions, subcontractor defaults, and strategic bankruptcies. These are the visible symptoms of an industry entering recession, not adjusting to a slow year. The contraction is synchronized across all price tiers, all regions, and all builder types. This is why the collapse cannot be dismissed as an Austin-specific problem or a luxury home phenomenon. The downturn reflects a deeper fracture inside the Texas economy, one that leaves every housing sector vulnerable as demand softens and financial pressure intensifies. The construction recession beginning here signals a statewide shift that will redefine development for years. The downturn spreading through Texas housing is not simply a supply and demand imbalance. It is the clearest reflection of a state economy losing the migration momentum that justified decades of expansion. The same pressures dismantling prices in Austin, San Antonio, and Houston stem from a deeper shift inside population flows and employment growth. When the state that led America in net migration for years suddenly sees a 62% collapse in new arrivals, every business built on perpetual growth begins to fail. Across Texas, the economic indicators that once supported housing demand are weakening simultaneously. Job growth, while still positive, has decelerated sharply. The June 2025 employment report showed modest job losses and large downward revisions to prior months. Sectors that drove in migration, technology in Austin, energy in Houston, corporate relocations to Dallas, are no longer expanding at rates that justify continued homebuilding at 2023 and 2024 levels. What makes this moment especially volatile is the convergence of slowing employment with rising living costs. Property taxes in Texas average 1.6 to 1.8% of home value, among the highest in the nation. Homeowners insurance has spiked 20 to 30% in 2 years due to climate risk and increased claims. Utilities continue climbing. And while Texas has no state income tax, the burden of these other costs has grown so severe that the tax advantage no longer offsets the expense of home ownership for middle-income households. Oil prices add another layer of pressure. At $57 per barrel as of late 2025, production becomes unprofitable for many Texas operators. When oil is cheap, rigs shut down, workers get laid off, and cities like Houston, Midland, and Odessa see immediate economic contraction. Energy sector layoffs don't stay contained. They ripple into retail, hospitality, construction, and real estate. A slowdown in oil country becomes a slowdown statewide. As these financial pressures compound, migration behavior undergoes a predictable reversal. People who moved to Texas for opportunity in 2021 and 2022 are now reassessing if job growth stalls, if housing costs consume 35 to 40% of income, if the state's competitive advantages erode, the calculation changes. And when migration turns negative, which some projections suggest could happen in 2026, the entire growth narrative collapses. What is unfolding inside Texas demographics is the engine behind the housing contraction. A reversal in population flow is powerful enough to strand inventory, depress prices, and force the market into a multi-year adjustment. When the state that symbolized American growth and opportunity cannot attract enough new residents to fill the homes it built, the signal is unmistakable. The Sunbelt migration story is ending, and Texas is where that ending becomes visible first. The migration reversal crushing Texas housing doesn't stop at the residential market. It forces a parallel contraction in commercial real estate that amplifies pressure across the entire state economy. As population growth slows and companies reassess expansion plans, office, retail, and industrial sectors face the same oversupply dynamics, now destabilizing housing. The same contraction that emptied subdivisions is now spreading to business districts, shopping centers, and warehouse parks, creating a chain reaction that reinforces the broader downturn. Office vacancy rates in major Texas metros have climbed steadily. Austin, which attracted significant corporate relocations during the pandemic, now faces companies scaling back or reversing those decisions as hybrid work reduces space needs. Dallas, Fort Worth, and Houston see similar patterns. Buildings leased at premium rates in 2021 are now offering concessions or sitting partially vacant. When companies shrink footprints, the second-order effects hit immediately. Less office space means fewer workers downtown. Fewer workers means less demand for nearby retail and restaurants. The urban core economies that flourished during the boom now contract in tandem. Retail is adjusting to the same slowing consumer. Shopping centers built on the assumption of endless population growth now report rising vacancies and falling rents. The pattern is visible in suburban developments where residential construction is stalled. Retail follows rooftops. When the rooftops don't materialize, the retail doesn't lease. Developers who plan mixed-use communities around 5,000 new homes now have 2,000 homes and empty commercial pads that can't find tenants. Industrial and warehouse space, which expanded rapidly to serve e-commerce and logistics, now faces its own reckoning. The pandemic-era boom in distribution centers created oversupply that is only now becoming apparent. As consumer spending moderates and companies optimize supply chains, demand for warehouse space softens. Lease rates are flattening or declining in Houston and Dallas-Fort Worth. New projects are being delayed or canceled, and properties that were valued as high-growth assets in 2022 are now being repriced 15 to 25% lower. The connection to earlier chapters is direct. When migration slows, housing demand falls. When housing demand falls, construction stalls. When construction stalls, jobs disappear. And when jobs disappear, commercial tenants struggle, retail traffic declines, and the entire real estate ecosystem weakens. This cycle is accelerating across Texas, leaving every property sector to confront the reality that growth assumptions underpinning valuations from 2020 to 2023 were unsustainable. The most concerning element is that these adjustments are structural, not cyclical. Markets are not preparing for a quick rebound. They are repricing assets for a slower growth future. When an entire state economy shifts from expecting 3 to 5% annual expansion to expecting 1 to 2%, real estate valuations must adjust downward. And that adjustment, once it begins across residential, office, retail, and industrial simultaneously, creates the conditions for a multi-year real estate recession. The real estate contraction sweeping across Texas is not emerging in a vacuum. It is the result of a decade spent building based on assumptions that migration, job growth, and affordability advantages would continue indefinitely. For years, the state attracted people and capital by offering lower costs and fewer restrictions than coastal markets. That strategy worked brilliantly until the tailwinds reversed. Now, the bill for overbuilding is arriving all at once. The burden sits on households who bought at peak prices, developers who built at peak costs, and lenders who financed at peak valuations. Texas homeowners who purchased in 2022 are now underwater or close to it. Builders who started projects in 2023 are delivering into a market with 10 to 15% lower prices. Banks that underwrote construction loans at 90% loan to value now hold collateral worth 75% of the loan balance. These forces create an environment where no participant has the capacity to absorb losses easily. The system is adjusting not through growth, but through contraction. The reset that was delayed during the pandemic is now happening compressed and accelerated. This is why the deterioration inside Texas real estate carries far more significance than declining home prices. Texas is deeply embedded in the national narrative of where Americans move for opportunity. Its model depends on growth, affordability, and a business-friendly environment that attracts both people and companies. When this state experiences sustained price declines, inventory at 14-year highs, and a 62% drop in net migration, it reveals a shift, not just in Texas, but in the viability of the entire Sunbelt growth story. Inventory levels, price cuts, and migration data are not isolated events. They are economic indicators disguised as real estate statistics. A housing depression does not announce itself with a single dramatic moment. It begins quietly through small decisions repeated by millions. Delayed home purchases, canceled construction projects, companies pausing relocations, families choosing not to move. These reductions aggregate into a statewide contraction that becomes visible first in the housing market before spreading into employment, retail, and state revenues. Real estate is that leading indicator. In Texas, with 156,000 active listings, 53% inventory above normal, and prices falling across every major metro, becomes the earliest and clearest warning signal of what is coming next. When the state that built more homes than any other cannot find enough buyers, when the migration magnet loses its pull, when affordability, the core advantage, disappears under the weight of property taxes and insurance costs, the message is unmistakable. The Texas housing boom is over. What comes next is the contraction. And the deeper that contraction runs, the more it reveals about the fragility of the assumptions that drove growth not just in Texas, but across the entire American Sunbelt.